Welcome back to the deep dive. Today we're popping the hood on a sector that you see absolutely everywhere. Everybody recognizes it, and almost everybody interacts with it at some point. But very few people actually stop to think about how the money is made.
Right. It's one of those things hiding in plain sight.
Exactly. We are talking about the engine room of India's booming luxury economy. But, and here's the twist, right off the bat, we aren't talking about the people building the engines. We aren't looking at manufacturing lines or robotic arms or, those massive gigafactories that get all the flashy headlines.
No, we are looking much further down the road, literally. We're looking at the point where the rubber meets the road. Or, I guess, more accurately for our purposes today, where the credit card meets the card reader. We're talking about automotive retail.
Specifically, we are doing a forensic deep dive into Landmark Cars Limited. Now, I want to challenge your mental image right here at the start. If you drive past a dealership, you see this shiny Mercedes or that rugged Jeep in the window, and you think, okay, simple business. They buy the car from the factory, mark up the price, and sell it to me.
Which feels like a standard retail transaction, right? Like buying a TV.
Yeah, exactly. But when you look at the stack of documents we have for this session, and we're talking annual reports, detailed stock analysis, credit ratings, and these really granular sector breakdowns, you realize that buying and selling cars is almost the least interesting part of what Landmark actually does.
I would honestly go a step further. If you think of Landmark as just a car seller, you are missing, about 80% of the strategic picture. It is much more accurate to frame them as a retail ecosystem. They are the gatekeepers between the factory and your driveway.
Gatekeepers, I like that.
Yeah, and that position is surprisingly complex. It's financially volatile, and frankly, it's vital to how the entire automotive industry functions. They're the actual infrastructure that the luxury market sits on.
And it is baffling when you first look at the numbers. I mean, this was the hook that grabbed me when I was going through the prep notes. We're looking at a financial paradox that just doesn't seem to make sense on the surface.
It really is a paradox. It completely defies the standard business logic of sell more, make more.
Let's look at the raw data for a second. In fiscal year 2025, Landmark pulled in revenue of over 4,000 crore rupees. That is massive scale. We're talking big league revenue, putting them in the top tier of Indian retail companies.
Yeah.
But then you look at the bottom line, the net profit.
Yeah.
And it was just 17.3 crore.
Which is incredibly thin.
Thin. It's microscopic. We're talking about net profit margins that have dipped as low as 0.4%. So the mission for this deep dive is to unpack that specifically. Why does a business with 4,000 crores in turnover even exist if it only keeps 17 crores?
And why are investors watching it so closely if the yield is that incredibly low?
Right. And how do you actually make money in luxury auto retail if the margins on the actual metal are that tight?
It's the classic volume versus value debate, but with a really unique twist. We need to figure out if Landmark is essentially just a logistics company moving metal for the big manufacturers, which would be a low-margin volume game, or if they are actually a high-margin service company that's just disguised as a car dealership.
Disguised as a dealership. That's a fascinating way to put it.
And importantly, what does this company's story tell you about the changing spending habits of the Indian consumer? Because they are betting big on a fundamental shift in lifestyle.
Absolutely. So let's lay out what we're working with today. We have a great stack of sources here. We've got detailed stock analysis from various firms, financial reports stretching from fiscal year 24 all the way through the third quarter of fiscal year 26, and some heavy-duty sector reports on the automotive value chain.
And what's really great about this mix is that it gives us a stereoscopic view. We have the hard financial data, the balance sheets, the PE ratios, which we will definitely get to, but also the strategic analysis regarding their relationships with big brands like Mercedes-Benz, Jeep, and Honda. We can really see the tension between the dealer and the manufacturer.
Let's start at the very beginning then.
Yeah.
The business model. The sources keep using this phrase, value chain. And it sounds like, MBA jargon. Let's strip that away. Isn't this just a car lot with a service center around the back?
It is a car lot, yes, but that is only one pillar of the structure. To understand why investors are even interested in this company, you have to break the revenue down into 4 distinct pillars, and they are absolutely not created equal.
Okay.
If you don't understand the margin profile of each individual pillar, the company just looks like a financial disaster.
Okay, lay them on us. Let's start with the obvious one. Pillar 1.
Pillar 1 is new vehicle sales. This is the flashy part. This is the whole showroom experience. Landmark runs dealerships for premium and mass market brands. We are talking Mercedes-Benz, Jeep, Honda, Volkswagen, Renault. They have also moved into commercial vehicles with Ashok Leyland and the electric vehicle space with BYD.
And just to give you a sense of scale here, they aren't some small local player.
No, they are a giant. As of mid-2022, the data shows they had 112 outlets across 8 states, and they are heavily concentrated in Gujarat and Maharashtra.
Which is a very strategic choice, right? They aren't just throwing darts at a map of India.
Absolutely not. Those are 2 of the wealthiest, most industrialized states in the country. High disposable income, very strong corporate presence. And here is a key stat from the sources. In fiscal 2022, Landmark was the #1 dealer in India for Mercedes-Benz in retail sales.
#1. So they are moving the most units for the biggest luxury brand in the entire country. That carries some serious weight.
Exactly. And they were #1 for Honda and Jeep in wholesale sales, too. So Pillar 1 is selling the new car. That drives the huge revenue numbers you saw, the 4,000 cars.
Because cars are expensive assets. Selling one Mercedes adds 50, 60, 80 lakhs, maybe over a quarter, to your revenue line instantly.
Right. But, and this is the crucial part that explains the low profit, the margin on that sale is tiny. The gross margins on new cars are often just 5 to 7%.
That seems incredibly risky to me. You have to pay for the inventory, the massive showroom lease, the electricity, the sales staff commissions. 5% doesn't leave much room for error.
It doesn't. In fact, for many dealerships, the new car sales department actually loses money on a net basis once you factor in all those overheads.
Wow, they lose money selling the car.
Frequently, yes. If you only sold new cars, you would be incredibly vulnerable to even a slight downturn in the economy. You are essentially just moving money from the customer to the manufacturer and keeping a few pennies for your trouble. Which brings us directly to Pillar 2.
Pillar 2, let's hear it.
After-sales service. This is the unglamorous part. This is the back of the building. Repairs, spare parts, lubricants, accessories, body shop work.
Stuff nobody really wants to pay for, but everybody absolutely has to pay for.
Precisely. And for Landmark, this is the holy grail. The sources refer to this as a high-margin, recurring revenue annuity.
Let's pause on that word, annuity. That usually refers to a guaranteed financial payout, like a pension or some insurance settlement. Why use that specific term for car repair?
Because in the luxury segment, it essentially is guaranteed. Think about it. If you buy a Maruti Suzuki 800, maybe you take it to a local mechanic down the street who charges half price. But if you buy a Mercedes S-Class or a Jeep Compass, you aren't going to take it to a random roadside mechanic to save a few rupees.
Definitely not.
The technology is too complex, the sensors are too delicate, and you really want to maintain the resale value. You are virtually forced to take it back to the authorized dealer, and you were going to do that for 5, 7, maybe 10 years.
So they sell you the car once, but they sell you the service 20 times. They have you captive.
Exactly. And the margins on service and spares, they are significantly higher. We aren't talking 5% anymore. We are potentially looking at 30, 40, sometimes 50% gross margins on certain parts and labor categories.
Okay, so that's the real profit engine.
That is the aha moment. Ideally, the new car sales cover the overhead, the lights, the rent, the fancy coffee machine in the waiting room, and the service department generates the actual net profit that goes to the bank.
It reminds me of the classic business school case study, the razor and the blade.
It is exactly that model. The car is the razor sold once, maybe at a low margin or even a loss just to get it into your hands. The service, the oil changes, the brake pads, those are the blades. You buy them repeatedly, forever. The car is really just the customer acquisition tool for the service department.
So Landmark is basically selling luxury razors just to get that sweet, sweet blade money.
That is a very accurate, if slightly cynical, way to look at it. But there are 2 more pillars that round out the whole ecosystem. Pillar 3 is pre-owned sales.
Used cars.
Yes. Facilitating the sale of used cars. This is interesting because it feeds right back into the ecosystem. Someone trades in their old Honda to buy a new Jeep. Landmark sells the new Jeep, that's Pillar 1 revenue. They take the old Honda, maybe refurbish it, that generates Pillar 2 service revenue for their own shop, and then they sell the used Honda, that's Pillar 3 revenue.
It keeps the customer and the car inside their loop. They don't let the asset leave the building until they've squeezed every possible rupee out of it.
It does. It maximizes the lifetime value of every single customer. And finally, Pillar 4 finance and insurance, which is often just called F&I.
How does that fit in? I mean, they aren't a bank. They don't have a banking license?
No, but they act as the agent. This is pure brokerage. When you buy that car and need a loan or need insurance, Landmark facilitates it through third-party providers. They get a commission or a referral fee for setting it up.
And since they don't underwrite the loan themselves, they don't take the risk if the customer defaults, right?
Exactly. It's pure commission income. Almost 100% profit margin on that specific transaction. Because there's no cost of goods sold, it's just a fee for signing the paperwork.
So to summarize the business model before we dive into the heavy financials, you use the low-margin, flashy new cars to get customers in the door. Then you monetize them through high-margin service, used car sales, and insurance commissions.
That is the ecosystem. And that fully explains the revenue versus profit paradox you started with. The revenue is absolutely dominated by the low-margin car sales. That's the 4,000 crores. But the profit is supported by the high-margin services.
Okay, that makes perfect sense on paper. But let's look at the reality. We need to unpack the financial situation because the numbers in the source material describe a bit of a roller coaster ride recently. We mentioned the huge revenue and the thin profit. But looking at the trend from fiscal year 24 through the projections for fiscal year 26, it seems like a real mixed bag.
It is definitely a mixed bag. If you look at the recent report cards, specifically the 9-month period of FY26, the top line is actually looking great.
Revenue is up.
Yes, revenue for that 9-month period was up 23.3% year over year. And in Q3 of FY26 alone, they saw what the report calls resilient demand in the premium segment.
Resilient demand. That sounds like corporate speak for the rich are still rich.
Pretty much. Specifically, luxury SUVs and high-end electric vehicles. The demand is there. People actively want the product.
So if sales are up 23%, why was the profit picture for FY25 so grim? The reports show net profit dropped almost 70% for the previous year. That is a crash. If I'm an investor, I'm not looking at revenue growth. I'm looking at that profit drop, and I am panicking.
It looks terrible on the surface, but you have to look at why it happened. It wasn't because people stopped buying cars. It was because the cost of doing business skyrocketed. And this brings us to a concept called operating leverage and its evil twin, fixed costs.
Break that down for us. What specific costs ate the profit?
Two main culprits, depreciation and interest.
Okay, let's take them one by one. Depreciation jumped about 29%. Now, for anyone who isn't an accountant, depreciation is usually a paper loss, right? It means your assets are getting older. Why did it jump so drastically?
It jumped because they bought a lot of new assets. In business terms, it means they invested heavily in infrastructure. Remember, they have over 112 outlets. They are constantly renovating showrooms to meet the new luxury standards of Mercedes and Jeep, which, by the way, are very demanding.
Right, they want the Italian leather sofas in the waiting area, the high-end lighting.
Exactly. They're opening new service centers, too. All that physical infrastructure counts as capital expenditure or CapEx. When you build a new showroom, you put it on the books, and you have to depreciate that asset over time.
So a jump in depreciation actually means they are expanding or upgrading. It's growing pains.
Correct. It's a non-cash expense. It's not money actually leaving the bank account today, but it hits the profit number hard. It signals they are building for the future, but they're paying the price on the scorecard today.
Okay, that's manageable. I can understand that. But what about the interest expense? That jumped almost 36%. That is actual cash going out the door to banks.
That is the debt. And this is crucial to understand about how dealerships function. To buy all those cars to sit on the lot, that's your inventory, you need cash. Dealerships run on working capital loans.
Explain the working capital cycle here. This seems totally vital to understanding their risk profile.
Sure. Landmark buys a Mercedes from the factory. They have to pay for it almost immediately, but they haven't sold it to you yet, so they borrow money from a bank to pay Mercedes. That car sits on the lot for, let's say, 45 days. Every single day it sits there, Landmark is paying interest on that loan.
Wow, okay.
So when interest rates go up, which they have globally and in India, or when you hold more inventory because you are expanding your footprint, your interest bill climbs rapidly.
So they are borrowing money to buy the cars from the manufacturer, holding them until I come to buy them, and paying interest on that loan every single day. It's like a ticking clock on every single car in the lot.
Exactly. This is called the inventory carry cost. If a car sits too long, the interest payments can actually eat up the entire profit margin on that car. And in FY25, that interest cost ate up a huge chunk of their operating profit. It's a classic case of investment eating into current earnings. They are betting that the expansion will pay off later, but right now the debt service is painful.
This brings us to the stock market side of things.
Yeah.
And here is where it gets really contentious. We have this company with thin margins, rising debt costs, and a complex business model. But when you look at the PE ratio, the price to earnings ratio, it is sky high.
It is startling. The source lists the PE at 72.12 times.
72 times earnings. For context, what is normal for this space?
Well, the industry median for this sector is around 44 times, so Landmark is trading at a massive premium compared to its peers.
Let's be real here. Usually, you see a PE of 70 for a high-growth tech company. You see that for NVIDIA, or some biotech firm curing a major disease, not for a company selling brick-and-mortar car service. Why are investors paying so much for so little current profit? Are they just deluded?
That is the multi-core question. When a PE is that high, it means the market is pricing in massive future growth. Investors are saying, we don't care about the 17 crores of profit today. We believe it will be 100 or 200 crores in a few years.
They're buying the future.
Exactly. They are betting on the razor and blade model scaling up significantly. They are betting on that operating leverage kicking in, meaning once the showrooms are built, the fixed costs stop rising, but the service revenue just keeps rolling in year after year.
But not everyone agrees, right? I saw one of the sources markets Vojo at a pretty harsh rating.
Yes, they rated it a strong sell.
Ouch. Strong sell is rare. Analysts usually prefer polite terms like underperform or hold, even when they hate a stock.
Their argument is based entirely on the fundamentals we just discussed. They look at the low profit margins, the high debt, and the financial stability scores. Specifically, they cite the Altman Z-score.
The Altman Z-score. That sounds ominous. What exactly is that?
It's a formula used by financial analysts to predict the probability of a company going into bankruptcy within 2 years. Now, we aren't saying Landmark is going bankrupt, far from it, but the score suggests below average financial stability. It highlights that the balance sheet is stretched thin. Markets Mojo is looking at that and saying, this is too risky. The price is simply too high for the performance they are delivering right now.
So we have a real tug of war. The optimists see a growth machine waiting to happen. The pessimists see an expensive, low-margin retailer with a heavy debt load.
Precisely. And to understand who might actually be right, we have to look at the strategy. Does Landmark have a way to win long-term? Do they have a moat?
Let's talk about the moat. In business, a moat is something that protects you from competition. If I want to open the Deep Dive Motors tomorrow and start selling Mercedes, can I do that?
No. And that is their primary advantage. OEM relationships.
OEM meaning the original equipment manufacturers, the car brands.
Right. You cannot just decide to sell Mercedes-Benz. You need authorization. It takes years, sometimes decades, to build that trust. You need massive capital. You need to meet their incredibly strict standards for showroom design, service quality, employee training. Landmark has that. They have the trust, and they have the scale.
So that's a real barrier to entry. I can't just compete with them tomorrow.
It is a barrier. And the sources are clear on this. They describe this advantage as modest and fragile.
Fragile? That doesn't sound very good for a moat. Why is it fragile?
It's fragile because Landmark doesn't own the brand. They are entirely dependent. If Mercedes-Benz decides tomorrow to change their strategy, say they want to cut the number of dealers or drastically change the commission structure, Landmark has to adapt. They don't call the shots.
They are playing in someone else's sandbox.
Exactly. And we see this vulnerability. They are smaller than some of their peers, like Car Trade Tech. They don't have the massive negotiating power that a global giant might have against the manufacturers.
So if the moat is fragile and the stock is expensive, let's look at the bull case. Why are the optimists buying in? What is the actual growth narrative?
The bull case is built on 3 or 4 major structural tailwinds in India. This isn't just about Landmark, it's about where the entire Indian economy is going over the next decade.
Okay, tailwind number 1. Let's have it.
Premiumization.
We hear this word a lot lately across different sectors. What does it actually look like in the auto data?
It means the shape of the Indian consumer pyramid is changing. The Indian middle class is getting richer, yes, but more importantly, the aspirational buyer is changing their behavior. 10 years ago, the dream for a successful professional was a premium hatchback. Today, the dream is a Jeep Compass or a Mercedes C-Class.
And the data supports this shift.
Absolutely it does. The sources note that while the overall volume of mass-market car sales fluctuates up and down, the premium and luxury segment is seeing highly resilient demand. The wealthy are getting wealthier, and the upper middle class is stretching their budget to buy status symbols. Landmark is positioned exactly in that sweet spot. They aren't selling the cheapest cars, they are selling the aspirational ones.
Okay, so more people buying fancy cars. Got it. Tailwind number 2.
The after-sales annuity we talked about earlier. This is almost a mathematical certainty. If Landmark sells 20,000 cars this year, that is 20,000 new customers who absolutely need service next year and the year after that. As they stack these sales up year over year, the fleet of cars they service grows larger and larger.
And that service revenue is the high margin stuff. So theoretically, as the fleet grows, their overall profit margin should expand because that highly profitable service revenue starts to outweigh the low margin new car sales.
That is exactly the hope. The more cars they have on the road, the more stable their income becomes, regardless of whether they sell a new car today or not. It makes the whole business much more defensive against downturns.
What about electric vehicles? Everyone is talking about EVs. Is that a threat or an opportunity for them?
For Landmark, it's currently an optionality play.
Unpack that term for us, optionality.
It means they are placing a smart bet without betting the whole farm. They have positioned themselves early with BYD. BYD is a massive global player in EVs, actively challenging Tesla worldwide. By becoming a key dealer for BYD in India, Landmark is hedging its bets. If the market shifts rapidly to EVs, they are ready. They aren't stuck with just traditional internal combustion engines.
So they aren't tied to the combustion engine. They are platform agnostic. They will sell you whatever moves as long as it's premium.
Correct. And they are also expanding geographically, which is another tailwind. They are aggressively moving into Tier 2 and Tier 3 cities.
The smaller cities.
Yes. Places where wealth is growing incredibly fast, but maybe there isn't a Mercedes dealership yet. Being the first mover in a wealthy Tier 2 city means you capture that entire local market before anyone else can establish a relationship.
So the growth story is clear. India gets richer. People buy fancier cars. Landmark services those cars forever. And they ride the EV wave with brands like BYD. That is the pitch. That is why people are willing to pay 72 times earnings.
That's the optimistic view, yes.
But on the deep dive, there are risks. We hinted at them, but let's get specific. What keeps the CEO of Landmark awake at night?
The absolute biggest one is cyclicality.
Meaning the economy goes up and down.
And luxury cars are highly discretionary. Nobody actually needs a Mercedes to get to work. If the economy slows down, if interest rates stay high, or if there's a recession, the very first thing people cut is the luxury car purchase. They just drive their current car for another 2 years.
And if sales stop, inventory piles up on a lot.
And remember that interest expense we discussed. If cars sit on the lot for 90 days instead of 30 days, the interest cost triples. That kills the thin margin immediately. A slowdown doesn't just reduce revenue, it can turn a profit into a massive loss very quickly because of the holding costs. This is a high-leverage business model.
That is scary leverage. What about the manufacturers? We talked about Landmark being dependent on them. Is there a risk they just get cut out entirely?
That is the direct-to-consumer risk. We see it happening right now with Tesla. Tesla doesn't have independent dealers. They sell directly to you through their website.
Right, you just click a button and they deliver it.
If Mercedes or Jeep decided to copy the Tesla model and sell directly, bypassing the dealer network,
Then Landmark just becomes a glorified delivery center.
or worse, they get cut out of the sales margin entirely. Now, in India, the dealer network is currently very strong, and local regulations protect them somewhat, but it is a long-term existential threat. The agency model is being discussed in boardrooms everywhere right now. In an agency model, the manufacturer sets the price and sells the car directly. The dealer just hands over the keys and does the prep for a fixed fee. That caps the upside significantly.
And what about the EV service issue? We said EVs are an opportunity because they sell them, but don't they need way less maintenance?
They do. This is the technological disruption risk. An electric motor has a fraction of the moving parts of a traditional combustion engine. No oil changes, no spark plugs, no timing belts, no transmission fluid changes.
So if the blade money, the high margin service revenue, is based on fixing things that break, and EVs just don't break as much.
Then the high margin annuity shrinks. The sources list this specifically as a long-term technology disruption risk. If the whole world goes EV, Landmark has to figure out how to make money on service when there is simply less servicing to do. Maybe it's tires and suspension, maybe it's software updates or battery diagnostics, but the old reliable model of routine service every 10,000 kilometers changes fundamentally.
That is a massive shift in the economics of the business. It turns the razor and blade model completely on its head if the blades suddenly last forever.
Exactly. It forces them to reinvent the service department. They might have to focus heavily on body shops, cosmetic detailing, or even software subscriptions.
Let's talk about the people driving this bus. Who actually runs Landmark?
It is very much a family-led business, the Thackers. Sanjay Thacker is the chairman and executive director.
And he owns a big chunk of the equity.
He holds about 49% of the company.
That is significant, almost half the company.
It is. In the investment world, we call this having skin in the game. When the chairman loses millions if the stock goes down, he's usually highly motivated to keep the stock up and the company healthy.
But it can cut both ways, can it?
It absolutely can. High promoter holding means retail investors like you and me are essentially just along for the ride. We don't have much say in the governance. If the family wants to take the company in a direction the broader market doesn't like, they have the voting power to just do it. However, the sources describe the management as having strong bandwidth and a genuinely good track record of execution.
They've navigated some tough times.
They survived COVID, which was an absolute nightmare for physical retail. They successfully pivoted to digital sales when showrooms were closed. They have managed these highly complex OEM relationships for decades without losing the franchises.
So they clearly know what they're doing.
They are true operators. They know the car business inside and out. The question isn't their personal competence, it's the structural limits of the business model they are in.
So we have covered a lot of ground here today. We have looked at the shiny showroom and the greasy service bay. We have looked at the booming top-line revenue and the disappearing bottom-line profit. What does this all mean for you as you're listening to this?
I think the key takeaway is to look past the brand names on the building. Landmark isn't Mercedes. It's a retail logistics and service company. It's a play on scale and service, not just selling metal to rich people.
They are trying to get big enough that the law of large numbers finally works in their favor.
Exactly. They're betting that if they can control a large enough chunk of the luxury market in India, the service income will eventually become a massive, totally stable river of cash. But right now, they are still in the very expensive phase of building the dam.
And the financial health is a bit fragile while they build it. High debt, low cash conversion. It's a classic execution play.
It is. If they execute perfectly, manage their costs, keep inventory moving quickly, keep customers happy so they come back for service, it could be a huge winner as India's wealth grows. But if they stumble, or if the macroeconomic environment stumbles, that debt becomes a very heavy burden very quickly.
It's high risk, high reward.
Very much so.
Before we sign off, let's leave you with one final provocative thought. Something to chew on that wasn't explicitly in the main analysis.
Here's what I keep coming back to when I review these files. Landmark trades at 72 times earnings. That is a valuation usually reserved for massive platform businesses like Uber or Zomato or Amazon.
Tech platforms, not physical retailers.
Right. So ask yourself, is the market just wrong? Is it just a bubble? Or is the market seeing something completely different? Is it possible that institutional investors aren't valuing Landmark as a car dealer at all? Maybe they are pricing in a future where Landmark becomes a dominant, consolidated mobility platform for wealthy Indians.
A mobility platform, what would that even look like?
Think about it. They have the premium customer data. They have the massive physical service network. They already sell the car, the insurance, the loan. Maybe in the future, they don't just sell you a car. Maybe they sell you a subscription to mobility. Maybe they manage your entire family's fleet of vehicles. If they can truly own the relationship with the luxury consumer, the car itself is just a hardware device. The real value is in the network they've built.
That is a fascinating way to look at it. Not a car dealer, but a luxury lifestyle gatekeeper.
Exactly. The numbers today absolutely don't justify the price tag, so the market is betting entirely on what happens next.
And that is exactly where we will leave it. A high-stakes bet on the future of the Indian luxury consumer. Thanks for joining us on this deep dive into Landmark cars.
Always a pleasure to be here.
We'll see you on the next one.